In the midst of these economic roller coasters, folks are getting jittery about what's happening. It's like watching a wild animal, not sure whether it's going to pounce or run away. The economy, that big, complex beast we all depend on, is throwing some signals our way, and they're not exactly shouting, "Good times ahead." So, first off, let's talk Wall Street. The economy is doing a bit of a limbo dance, and some people are saying, hey, this might be good news for the stock market. It's like when your favorite team is losing, but you're secretly hoping they'll come back stronger in the next game. That's the vibe some folks are getting about stocks on Wall Street. Then there's this bank bailout program making a comeback. Now, that's not the kind of comeback you celebrate with confetti and streamers. It's more like, oh, what does this mean for the future? Banks tapping into bailout funds again? That's like a red flag, waving in the wind, signaling trouble ahead. We've been down this road before, and it's not a scenic route. Now, let's lace up our sneakers and talk about Nike. Their earnings report showed they beat expectations by a whopping 21%. That's like acing a test you thought you'd fail. But, hold on, their stock took a nosedive, around 11%. Why? Weak guidance. It's like saying, yeah, I aced the test, but I have no idea what's coming next. Consumer behavior is getting in the mix, especially among the folks with tighter budgets. Nike's blaming softer revenue in China and a globally cautious consumer. It's like they're telling us, people are being careful with their cash. Speaking of cash, there's talk about the lower 60% of Americans facing higher credit card debt. That's like watching your bank statement grow, and it's not because you won the lottery. People are worried consumers might hit the brakes on buying stuff they don't absolutely need. Companies like Peloton and Ulta are feeling the pinch, throwing out promotions like candy on Halloween. It's like they're shouting, "Come buy our stuff, please." And there's this Sam rule floating around, analyzing monthly unemployment changes like a crystal ball. If it's right, we might be heading into a recession. On the brighter side, the Bank Term Funding Program is raising hopes for rate cuts. It's like a financial seesaw, going up on one end and down on the other. The market is getting ready for those rate cuts, speculating like mad. Will it help? Will it make things worse? Nobody knows for sure. Meanwhile, companies are thinking about advertising more. It's like they're gearing up for a battle, expecting consumers to tighten their wallets. Smaller banks, though, might be in for a rough ride with more people withdrawing their cash. It's like everyone's trying to grab the emergency exit at the same time, causing a bit of chaos. Now, let's take a trip back in time to the 1970s. Some folks are comparing today's economic mess to that era. But, hold on a second, it's not an exact match. There are some things in our favor. Inflation is stable, unemployment rates are lower, and the Federal Reserve seems to be doing a better job. It's like saying, yeah, things are rough, but at least it's not as bad as it used to be. Inflation expectations are holding steady, and people are skeptical about a 1970s-style inflation comeback. It's like everyone's hoping we won't have to relive the fashion disasters of the 70s, bell-bottoms and high inflation. But, here's the catch, we shouldn't rely too heavily on history. It's like trying to predict the weather by looking at your grandmother's knee. Times change, and so do economic landscapes. So, what's the takeaway from this economic circus? It's a mixed bag of concerns, speculations, and a bit of hope sprinkled in. The economy is a tricky beast, and right now, it's throwing us some curveballs. Buckle up, folks, it's going to be a bumpy ride. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.